Over the summer, Congress passed a large tax package within the One Big Beautiful Bill. People watched closely as it moved through the legislative process to figure out how it would play out and what impact it would have. But here's the twist. The biggest market-moving changes often don't come from Congress. They come later, quietly, from the Treasury. To see why Treasury's impact can be so powerful, it helps to remember how tax law actually works. Congress writes the big picture rules, but it often leaves out the fine print. Treasury then steps in to write detailed regulations for how the law is applied in real life. We saw this after the last major tax overhaul in 2017. As a part of that package, Congress created a new minimum tax on foreign income, the GILTI tax. In our research, we examined how firms and markets reacted as the details of that new tax emerged. From the start, evidence suggested that GILTI would raise tax burdens for many multinationals, and the statutory language left a lot of open questions. Firms faced both an unexpected increase in taxes and major uncertainty about how those taxes would actually be calculated. That's why Treasury's regulations matter so much. When Treasury released the first GILTI regulations, something unexpected happened. A tax that everyone thought would be costly suddenly looked a little less painful. A single clarification allowing loss sharing across consolidated companies flipped the market's expectations. In our research, we document a clear uptick in valuations for affected firms on the exact day those regulations were proposed. As Treasury now works through the newest tax legislation, these regulatory decisions will again play a major role in shaping how companies operate and how markets respond. Watching Treasury is just as important as watching Congress.